Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world.
Hello, Greg here from the future. Just before this episode starts, I should warn you, this was recorded not in my usual location. And because of that, unfortunately, the audio is a little bit all over the place on my behalf. My guest audio is fine. So apologies for that in advance. But it is worth saying a huge thank you to Seed Legals and Anthony, the CEO there at Seed Legals, for allowing me to use one of their offices in their new office space in London as I was out on a trip and I was in a bit of a bind and I really wanted to continue to speak to my guests today, Mike. So huge thank you to Seed Legals for doing that. I'm going to put their information in the description below just as a way of saying thank you. So do check them out if you're raising money or you need help with SCIS and all that kind of stuff. They're a great resource for that and a load of other things too. So thank you to Seed Legals. Thank you to Anthony and the whole team for looking after me that particular day while I was out and about and needed a place to record this podcast. But unfortunately, it does mean I didn't have my usual equipment with me, so the audio is a little bit rough. So apologies for that, but it's still a great episode. Mike is still a fantastic guy. You really should be listening to this episode. So thank you very much for tuning in and see you in the next one. Cheers.
My name is Mike Bank. I am one of the partners at Underdog X, and we help individuals dip their toe into the entrepreneurial waters, launch businesses in an ideal world, but often just allow people to play around a little bit and figure out if starting a business is for them or not. So that's what I do today. And happy to talk about how I got there, if that would be helpful.
Yeah, absolutely. I know we touched on it very briefly when we spoke before, but I want to get in the weeds on that 100%. Tell us how you got into that.
Definitely. Cool. So I'll kind of go back a fair amount. I've got grey hair, as you can probably tell on camera. So I've been around a little while and seen highs and lows in the cycle of entrepreneurship and venture generally. But I started my career in investment banking for my sins. And I spent just under 5 years working in mergers and acquisitions on massive deals, multi-billion-dollar deals, as well as some smaller ones by that count. But what today in my world will be absolutely ginormous. And I joined at the height of the M&A boom back in 2007. There was tons of stuff going on and it was really exciting. And then the great financial crisis came and 2008 rolled through, and a lot of the big deals that we were working on just got scrapped essentially. So my initial plan had always been to kind of cut my teeth in banking and then leave relatively quickly after maybe a year or two and jump off and do my own thing. But because of the cyclical downturn, basically, I thought I'd better stick around a little bit longer to get a breadth of experience. And it also helped that the people that I was working with, although this may sound strange, actually were awesome. So I was working in a great team with awesome people who were exceptionally good at their job. And actually, frankly, for one of the first times in my life, felt like the dumbest person in the room, which I think is a great place to be because it means that you are growing and you've got the ability to learn by osmosis and develop as an individual. So that was great. But over the years, what I found happening is that I was naturally kind of migrating towards the founder, owner operators who had built businesses from the ground up typically and were still the owners. They'd often taken private equity funding. So they had been funded by external investors and they had maybe given up large chunks of their companies, but they were still the owner operators in that they still had sometimes slivers of equity, but they were still running the businesses that they built. And these were the people that most excited me. It wasn't the massive mega deals that were run by professional CEOs. It was the companies that had been built up and were maybe being sold for $500 million, something like that. And I would actually at times get in trouble. So some of my bosses, because I would work with them on tiny deals. I think the smallest deal that I did was maybe 30 million euros, working for a bigger company, but just helping out their corporate M&A guy, the individual that was trying to do that deal on their side, and giving him support from my budget, my time, and my team. And maybe rightly or wrongly, I got shouted at by one of the directors in the team saying, "Why are you wasting time on this tiny deal? we're not going to make any fees from it. Obviously, the deal was too small. Even if we were making fees, it would be inconsequential. And I think the point that he missed was that I was building a relationship with that team, with this individual, so that when that company did actually end up being sold, it got sold to another company, an external acquirer, we were the lead on that. And I'm not saying that was all down to me, right? I can't take full credit for that. But that certainly helped smooth the way. And because we had worked together and built that relationship, it just made my life as like a junior mid-level banker that much easier. And that wasn't the only entrepreneurial client I worked with. I had a small batch of them. And I tried to carve out a little niche for myself working with these individuals. And not only did I enjoy working with them, but it seemed, at least to me, that they enjoyed working with me. And that was borne out by the fact that often in meetings, I would typically be the most junior person in the room from our side, but they would be addressing their questions and thoughts to me. And it just set something off in my head. And I was like, wow, this is the life that I'm interested in. I was coming to a crossroads basically in my career where I could either double down and become a full-time investment banker and dedicate my life to that. That's not what I wanted to do. I wanted to work with these entrepreneurial clients. And I ended up doing, have you heard of a chap called Tim Ferriss who wrote The 4-Hour Work Week?
So
you heard of him?
Yeah, vaguely familiar with the name. Yeah.
So I think he wrote that book in 2007 when I was joining the bank, and I probably bought it back in 2007 and read it cover to cover several times well, we didn't really have lunch breaks, but in my spare time. And at the time, you're going back to like 2010 probably, he was talking on his blog about the real world MBA. And that was a concept where you would take your business school money and rather than paying it to Harvard or Stanford or whoever else, you would actually invest it in a hands-on way into early stage companies, roll your sleeves up and get actively involved and take those investments as a sunk cost, as in don't expect to get any money back from it, but get all the benefits of learning by experience, by rolling your sleeves up, and building a strong network in the world of early stage venture, which is essentially what you're getting from a business school. Network and a bit of sort of maybe not so practical, but a bit of knowledge at least. So I would never recommend this to anyone, but I did make that leap. And that was after having looked to acquire a small business in a sort of management buyout is what we will call it in big finance. But in this case, it was essentially just finding a company with a retiring owner, but a lieutenant to that owner, second in command, who wanted to carry on the business but didn't have the funds to buy it out for himself. So we partnered, and I took all of my great finance knowledge that I'd acquired over the 4 or 5 years in investment banking and, wrote all sorts of letters and developed financial models and put an offer forwards. And we were rejected. And it shocked me, not only because I hate losing, I really do hate losing, but because our deal, I think on paper, was better. But it was so complex and convoluted that this retiring business owner just didn't really get it. And I'd failed to do what I was exceptionally good at in my day job, which was to build a rapport with that owner. Yeah. And that just set off a light bulb in my head. I was like, man, I need to focus on this full time. I can't be doing it on the side whilst I'm trying to do my day job. I need to, basically pull the trigger and utilize. So my dad, bless his cotton socks, told me loads of wonderful things when he was still alive. But one of the things that he instilled in me was this concept of having, trying to think of a polite way of saying it, but F off money, basically. Like a fund that you've got in the background so that you are not reliant on anyone else.
Fuck you, money.
Oh, good. We are allowed to swear. Fantastic.
Oh,
yes.
Yeah.
Fuck you, money.
It's usually just not within the first 10 minutes of a YouTube video, but after that, you're good.
All right, good. Well, hopefully we've gone over time. So that's essentially what I had built up anyway. I built up my FU fund. I'll try not to swear so much. And I pulled the trigger. And, like my boss was great. We're still, not like besties, but we're still friendly to this day. And he was super supportive. But the hilarious thing was, when I resigned to him, he said to me, well, what are you going to do next? And I said to him, David, I've got no idea. And he burst out laughing. He thought it was hilarious. And ultimately, I didn't really have an idea. I had no specific idea. I just knew that I wanted to get involved in early stage venture. Seeing these people who had, over the course of 10, 15, 20 years, built up awesome businesses made me think I want a piece of that. What I didn't want to do is focus my time on only one thing. I didn't have a specific passion that I wanted to get involved in. I just love business and entrepreneurship. So the best way for me to get involved in that was similar to being a banker, where you're working with multiple clients on different projects and juggling many balls. I wanted to do the same thing in early stage venture and not put all my eggs in one basket, but work with loads of interesting people on cool things that might have a positive impact on the world. So I ended up doing that real world MBA. Actually, it didn't turn out too badly for me, but I certainly wouldn't recommend it to anyone unless you are genuinely prepared to lose all of that money. And that was mid 2011. I resigned, had a bit of gardening leave, kind of non-compete type stuff. Went traveling, enjoyed myself, and actually got a text off my old boss whilst I was on the beach in Brazil, saying, "Oh, you could have stuck around. We're doing another round of redundancies. I'd have made sure you got a decent payout." And I think I texted him back and said, "Yeah, I wasn't sipping a pina colada, but I'm like having a beer on the beach in Brazil. I'm probably okay. Life is good.
Things could be worse. Yeah.
Definitely could have been, a lot worse. And I think, frankly, and it wasn't a great time. Let's be real. It was not a great time to be in banking. The highs of 2007 never came back again, certainly during my tenure all the way through to mid-2011. In fact, I'd seen 2006 as well. 06, 07.
Yeah. Look, you were saying, I'm just curious about something, because you were saying, you kept saying you were drawn to this thing, like a mosquito to a light kind of thing. But have you thought what it is about venture that attracted you so much? On the entrepreneurial endeavor, like what was that? Like, where did that come from?
So there's a history of entrepreneurship, at least on my dad's side of the family. So that had always stuck with me. And my granddad had his own business that he built from scratch, and had retired when my dad was very young. So he'd been present when my dad was growing up, whereas my dad had gone down a corporate path. We say, as kids, we're kind of counter-cyclical to our parents. So his dad had built his own business and retired early. My dad had taken the opposite path and said, that's not smart. Let me go and work for the man. And he worked for a massive tech company for his entire career. And then I looked at what my dad did and said, no, that is definitely not for me. I am not a lifer. And I think maybe it's a generational thing as well. Like the security of having a full-time job just didn't really exist. And that became clear to me in 2008 because half the team got...
It just doesn't exist really anymore, does it? Let's be honest.
I don't think so.
No. It's just people blame employees for that, for jumping from one job to the next, but it's just not the case. It's on both ends of the spectrum. Like, you're not given the same level of. I know I've done it, as you have. You're not even given that impression when you first join a company that they expect you to be there for longer than sort of 2 to 3 years these days. Do you know what I mean? Where do you see yourself? And what companies do you want to work for after this one? You're like, what? So it's a very different landscape. Being a lifer in a company, just I don't know. At least in this space, maybe in other fields, it is. I don't know. Engineering.
It did exist. In banking, they did exist, and some of my bosses had been with the same company for decades, right? Same as my dad had been. I think for my generation, that kind of generation of employee. In the UK, it was slightly different, but certainly in the US, they expected you to churn after 3 years. You would cut your teeth for 3 years as an analyst, and then you were out the door to do an MBA, to then maybe come back as an associate. But there was almost an expectation that you were not going to last, which was probably in part because they treated us like modern day slaves, well, paid slaves, I suppose. But, my old boss, he used to joke that he was on call 24/7. It was just an expectation. Even when he was walking down the aisle, he had to have his phone on just in case a client called. And that simply wasn't a life that I wanted. And actually, one of the things that's really core for me and what we do at Underdog X is trying to understand any individual's motivation for, well, almost anything they want to do, but certainly in this context, for starting a business. And consistently, because I redo it every 6 months or so, at the top or very near the top is freedom and flexibility. And that's been born out of the fact that I was working 100, 120 hour weeks, not every week, right? Although some people were, but like an 80-hour week would be normal, and working 6, maybe 7 days a week was not abnormal back then. It was nuts. And that wasn't something that I was prepared to endure forever, because life is short, right? And I think we need to make the most of our youth and our health whilst we still have it. And that wasn't going to be, like working in banking and working ridiculous hours is not really sustainable in my view. For some people it might be, but for me it certainly wasn't. So there was a push factor there.
It's a double-edged sword though, isn't it? Because if, regardless of career paths, like when you're in your early 20s, when you're just in your 20s, full stop, really, if you're free, you're single, you haven't got kids, like that is the time to move mountains. Like if you're going to do, if you're ever going to want to put a lot of money in the bank or really, make waves, build something that no one else has built, and work, 7 days a week, 100 plus hours a week, that is the time to do it, because it only gets harder. Like every year after 30, it just gets harder. So like it's a double-edged sword, but at the same time, if I wouldn't actively encourage it either. You know what I mean? It's a tough thing. When people ask me when they're that sort of age grade, just come out of uni or something like that, and they're asking me about, what should I do? Like, I'm like, dude, you've got everything. Like you've got the thing that we all want, and we don't have time. Like you've got youth. Like you've got energy. Like I'm tired just getting off a chair. You're fine. So, but it's tough. It is tough, because I also don't want to encourage people to kill themselves working. Do you know what I mean? Like it's a fine line. So.
Look, I think it is tough, and I went into this industry and into the world of work with my eyes wide open, because during uni I'd spent a summer interning at a big professional services firm. You'll have to look on my LinkedIn for the name. I won't say it here, but one of the big four, basically, I interned at. And one of the partners who I align myself with, because that's basically what I've done in every job I've had, is I found people who I aspire to be like, and I try and make their lives easier so that they will want to work with me. And exactly the same with David, my old boss at the bank. And with this guy, I'd align myself with him, and he was, I think, the youngest, if not one of the youngest partners at this firm. And an article had been released saying that, for the first time ever, partners at this firm had been paid on average 7 figures, i.e. £1 million or more. And I kind of went into his office and joked with him about it. And he said, Mike, remember, that is the average partner. Not every partner has got paid that. And I said, yeah, but the best get paid more, right? And he found that quite funny. But we talked about it, and I said, well, you are exceptionally young. Like, how have you got here? And he said, Mike, you have got to make a choice. And he was kind of opening my eyes to this. He said, the choice that I made is that I did work my butt off. In my 20s, I worked super, super hard. I think, at the time he was really old, but he was probably in his early 30s, maybe not even. And he was like, I worked my butt off, and I sacrificed my family life. I sacrificed having fun. All I did was work. But that means that now I can almost cruise. He still worked hard. But, I've made it, now I can cruise. But you have to make that choice as to whether or not you want to defer your happiness for later in life when you might not be as able to enjoy it for all manner of reasons. And that always stuck with me, because he didn't give me the answer. He didn't say, this is what I suggest you do. He just said, these are the options. So at least I went into it with my eyes wide open, but I didn't have the answer. And I first retired, or semi-retired, if you want to call it that, at the age of 27 with my FU money in the bank. And that wasn't to say I would never have to work again, but, if I tempered my lifestyle, I pretty much didn't, right? So I was exceptionally lucky, and I made some bets, some investments that had paid off. So I was in a good place. But I knew that I didn't want to be twiddling my thumbs and playing golf. Well, one, because I was terrible at golf. But,
Hi, a friendly reminder to share this episode with your network, like, and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
but mostly because I just wanted to be active and doing stuff. But I wanted to do stuff on my own terms, probably similar to you, right?
Well, of course, I mean, look, we all need purpose. I can't think of anything worse than not doing anything. And almost everyone I speak to, as I've been in that scenario or thought about it, right? There's plenty of investors I know that don't need to do anything. Like, yeah, I mean, idle hands and all that, right? But the thing is as well, I mean, like, just even given that choice of like you said, from your old boss who gave you that choice, and there's also just no guarantee that actually it would work, that you would actually manage to do what he did and get to that point, and be able to effectively sort of retire early or just coast or however you want to phrase it. Like, that's still not a guarantee. Things go wrong. Like, so you could end up, spending all of your 20s, maybe some of your 30s, working your absolute fingers to the bone with this idea of just sort of building it up, like you said, and then being able to coast the rest of the way. But things could go wrong, and you might end up having to do that until your 40s, your 50s, and then guess what? You're just in the same position as everyone else. Like, so there's so many variables that you can't control in that situation. And like you said, all you're doing is deferring your youth to some extent, and sort of pushing those, like friends, family, all of that down the road. And you can only do that so long, because the other thing that, we need youth for is like raising a family, like that's another important thing that energy and youth is pretty good for, so, you don't want to miss that boat either, if that's something that's on the radar.
100%. Yeah. And I guess that was another push factor. There was another one of the MDs, like quite a senior managing director, and he'd been with that company for probably 30 years. And I remember I was working, just me and him, on a deal. And it was one summer, it was roasting. He had a lovely corner office with floor-to-ceiling windows, and it was boiling because I think the AC was off. And we were on this dull conference call. And I was thinking, oh my gosh, this is a load of BS. And to my surprise, he actually put himself on mute, and he looked at me and he went, "What are we doing here?" And I was like, "Hold on." It was almost like the fourth wall had been broken. I was like,
yeah.
I won't say his name, but I was like, well, that's a good question. And I said to him, genuinely, what are you doing here? Because I knew through the grapevine what he was getting paid and what he had been paid historically. So he had, more money than any individual could spend, or so I thought at the time. And I kind of posed that question to him, and he said, "Mike, I've got a really expensive life. I've got a wife, I've got 2 kids, they've got ponies and private school, and she's got their own hobbies." He said, "I cannot afford to retire. I've got to keep going." And again, another light bulb went off in my head, which is, have you heard of the FIRE movement, financial independence, retire early? Have you ever come across that?
Yeah, I've been part of their Reddits and stuff like that.
Yeah, it's fascinating to me. I don't know that much about it, although in principle I can kind of take the best bits of it. But the bit that always interested me was that there were 2 ways of doing it. Or, the 2 bookends of doing it are to reduce your cost of living to a minuscule amount so you can live forever on very little. I get what that's called, lean fire, I think. And then there is fat fire, which is you just try and make as much money as possible, as early as possible, so that then you can do whatever the heck you want. And naturally, I mean, I don't know about you, but naturally, like the lean fire, like cutting my expenses, I mean, it's part of it, right? You've got to be sensible in life, but that never really resonated with me. But the fat fire piece really did. And as you rightly identified, Greg, you can make best efforts to make a ton of money and do everything right, do everything within your control that is right, and external factors can scupper your plans. Yeah. Things can happen, things can go wrong. So I think that probably I'm in my 40s now, right? So I'm kind of finding a happy medium where I've managed to make my expenses sensible, but also I am always looking, and this is the important bit, I'm always looking for an asymmetric upside on the back end.
So that's exactly what I was going to say. The key is to find a way of doing both. It shouldn't be one or the other, because that's not sustainable. Like that's a dangerous game to play, you know. Yeah. No.
I mean, to be frank, I probably spent my 30s doing the unsustainable stuff and living an amazing life. But then turning 40, I was like, okay, now it's time to knuckle down again. And you're right. It's not as easy as it was in my 20s. If I had to go back to investment banking or any job really and work, I don't know, 14-hour days, 7 days a week or longer, I'm not sure that I could physically or mentally do it. It just wouldn't happen. So I need to be more sensible in how I work. But also, I think over time, and you'll probably have noticed this as well, you become more efficient. And I always say that I'm intrinsically lazy, which is a great thing because it means that I've got to find the path of least resistance to get the result that I want. And that plays in my favor. But yeah, look, ultimately, for me, like earning lots of money every single year, okay, might be great. And in some years, of course, we do that. But I'm happy weathering the storm of lumpy cash flows if there is a chance, or in my case, many chances of a massive outcome on the back end. I don't want to be average. I'm not interested in that. I'm interested in what may be a low probability, but an enormous outcome on the back end. And that's why naturally I was drawn to venture, and naturally probably more to the investment side of venture than building one thing where the outcome is pretty much binary. Either you're going to make it massive or you're not, and you've got one shot. Or maybe another shot, but never concurrently, right?
Yeah, and yeah, I mean, obviously we're going to get into the venture side, but just really quickly, you mentioned something a minute ago as well about, you know, that guy you spoke to that talked about how, you know, he's got an expensive life. That's another really important thing to bear in mind too. Like, you know, the more money you have, the generally more expensive your life becomes on a regular basis, and you need to maintain. And that's not something people think about at all. Like, you know, I know so many people that, you know, fail to just really use a little bit of common sense to think about how, you know, I mean, there's a reason why we say more money, more problems. Things need to be maintained. You don't just go into the world and buy things outright. And, you know, once you start planting roots, especially, those roots need to be paid for. And the individuals that come with you on that journey require a life and a roof, you know, over their heads too. So it's like, it's just an important aside that I think that a lot of people, like when people talk about money, especially when they talk about, you know, wealth, it's you could look at, like, people don't quite realize how little like $1 million is in a long term, for example. I mean, obviously from a short term perspective, it's fucking life changing. And like anyone would, you know, would very rightly so love to get like $1 million put in their bank. But when you start looking at it from an age perspective too, like, you know, what would you do with $1 million in your 20s versus in your 40s, or if you had kids, or if you were, you know, married and so on? Like, it's just a complete, you know, that's just gone in a year, you know, on some pretty boring stuff, you know. So it's important. I just think I'm just pointing that out because I think it's important for people, especially as a lot of founders, CEOs, or budding entrepreneurs watch this and listen to this show. I think that's an important thing to realize, especially when you're thinking about exit strategies and stuff like that. Like, what should be your goals financially? Because it's, you know, there's a reason why there are a lot of previously exited founders that are still working. You know? So it's not, you know, sometimes 2, 3, 4 time exited founders and they're still grinding. It's like, well, you know, they've got to pay those bills, mate. You know, that mansion ain't going to pay itself. But really quickly, just from a tech perspective, I think I'm going to have to turn these. I think these are running out, so I'm going to put these on charge, and I'm just going to use the mic on the camera, if that's okay.
No worries, man.
But I'm not going to edit this out. By the way. I like the authenticity. Yeah, but I will also address really quickly before I do that to the audience. Those watching, they'll notice if they're watching, I'm in somewhere completely different. I'm actually in the Seed Legal's office at the moment today. So apologies if the audio quality isn't as good as it normally is, etc., etc. And it may even get worse because I'm about to use the microphone on the camera. So apologies in advance, but we'll hopefully put this back on in a moment. So bear with me 2 seconds. Let's just keep going, and if they run out, we'll deal with it then.
All right. Yeah. No worries. We'll try.
You know, uncensored conversations at the end of the day, so screw it, it's fine. It did give me a warning, but if it cuts out, because I just realized I can't change the microphone as we're talking, so I'll have to end the recording to do that. So let's not worry about it. But yeah, so look, you then started talking about venture and kind of really what getting to the crux, I guess, of what attracted you. So essentially, what you did is you decided to essentially become an angel investor, right? And the reason behind, but quite a hands-on angel investor from what I understand. So you were very much operationally getting involved in these investments, with the idea of kind of wanting a trial by fire into this space of venture and startup. Is that a pretty good summary of kind of how
Yeah.
you entered in? Yeah.
So, I mean, so my plan obviously didn't, well, not obviously, but my plan didn't pan out how I expected. And there was a good reason for that.
Sorry to interrupt. I've got a quick message. Please don't skip. It's an important one. So look, if you've listened to this show for a little while now, you'll know that quite often the subject of mental health and psychology comes up, especially in the context of being a founder. What's interesting is more than 70% say that they're affected and less than half get any kind of professional help. Founders usually struggle to find someone who understands their work, the startup ecosystem dynamics, or even just the terms that they use daily. Well, I'm really happy to say that there is a real psychologist who is actually a startup veteran and developed a unique approach tailored for us founders. Yariv Gaynor has been working in startups since 2005. He was a CMO and then he pivoted to clinical and industrial psychology. He's been working with founders worldwide to help them with issues such as imposter syndrome, anxiety, burnout, and more, as well as co-founder and founder investor crises that are very common in startups. Yariv's approach acknowledges that mental well-being of founders is key to them being at peak performance, and that's what he's focused on. Whether it's in a private one-to-one session or joint co-founders process, Yariv provides efficient support that's based on psychological tools and knowledge. Please do check out the link in the description to see what he's all about, get in touch with him, have a chat. If you're someone that feels like maybe you could do with this sort of support. If you're watching this, there'll be a QR code on the screen. Just scan that and it will take you to his website. That's it. Thank you, Yariv Gaynor, for sponsoring this episode. Let's get back to the conversation.
But I essentially thought, let me just immerse myself in the world of venture. Let me jump in feet first, just start putting myself out there, saying yes to every opportunity, not investment opportunity, right? But saying yes to any opportunity to go to a pitch event or a networking event or a workshop and just really network my way in, and relationship build first and foremost. So that's what I ended up doing. And a big part of that led to me actually meeting a couple of guys who were running an early stage venture fund, and me, given my background, being in a position to plug the gap that they had. So they were one technical and one commercial, kind of sales go-to-market oriented. Saying I kind of jumped in feet first and yeah, got my toes wet at the very least. But my plan to solely focus on angel investing didn't happen, because by saying yes to all these opportunities to go to events and stuff, I actually met a couple of guys who were business partners in their tech startup, which was spitting off cash and running on autopilot, and had then decided to set up their own early stage venture fund. So they were probably the earliest institutional investor in London at the time. You're going back 2012, end of 2011, early 2012. And one was a very technical guy, was able to build products. The other was very commercial, able to sell products and services. And in my case, I was sort of like a missing gap for them, or they took a shine to me. I was a bit younger, I suppose, and had that youthful vigor and energy. They were excited. I was excited. I was investing my own cash, and I had that financial aspect that they didn't have between them. So I started working with them and helping them with the investments they were making, on the understanding that I was able to join the same deals, basically. So have access to deals that I wouldn't have otherwise had access to. So that was kind of cool. And then I also ended up going into, I guess you would call it a startup, an established but small company that some of my banker friends had invested into, and acting a bit like a kind of MBA associate. So going in without having an MBA and just taking a look at it from an outsider's perspective and figuring out what was going well and what wasn't, and trying to put forward ideas on how to fix it. And that led to me being able to, in lieu of getting paid, I said, don't bother paying me, but if there's an opportunity that I see, I want you to support me in that. So I ended up taking a division of that company that was underperforming and completely unloved, took that on myself essentially for free. Well, nothing in this life is for free, but I got it for nothing and then pumped, a lot of money into it to turn it around. So I did a micro turnaround there, and I was doing the, I guess, angel investing / early stage VC investing at the same time. So that was kind of cool.
I mean, that's a lot of plates to spin, but I mean, that's what you said you wanted to do, right? You didn't want to just focus on one thing. You wanted some variety. So by the sounds of it, you absolutely got that. So how long were you doing that for then before you kind of, you then stumbled in, I mean, unless there's something else in between, but before you stumbled then into the concept of Underdog X?
So yeah, I'll try and like fast track and fill in the gaps. So we were actively investing out of the fund. That was great. But if you remember, these guys had run a business together and had done exceptionally well. And I think for all of us and for any aspiring angel investors, you have to be aware that up to the point of investment, founders are going to be super receptive. After you transfer the cash, they may not be that receptive, right? And that lack of control, especially when you could see the pitfalls and you could see where perhaps, at least in our opinions, the founders were going wrong, that was completely out of our control. And I don't know if that was the sole reason, but certainly they were getting itchy feet and they wanted to jump back into the world of building. But again, and maybe this was partly my influence, not to focus on any one thing. So we ended up, before I think they were called or commonly known as venture studios, we ended up building a venture studio. Their fund put the money in to incubate ideas. They hired a couple of people. And then I ended up continuing angel investing and then eventually joining them in the venture studio, where we spun out one of the ventures and got external VC backing to support its growth. So that was the next stage. It was kind of venture building, then one venture-backed company, which ended up failing. And then off the back of that, building more companies with one or both of these individuals over the next few years, before eventually I joined a startup accelerator called Antler. I don't know if you've heard of them.
Yes, rings a bell.
But, and I never like to assume, because for me, they're like massive. I think they're one of the most...
We talked about this before. You said that there were so many people that just weren't familiar. And I was like, really? Like, I just assumed that was like a staple. Like, that in this space, just people... Like, if you've been in startups for a couple of years, you would recognize the name, but apparently not. So...
Oh, yeah. I mean, so many, especially regional investors. Maybe I've never heard of them.
Yeah, I guess. Yeah.
Yeah. And yeah, like founders in particular, just not on their radar for whatever reason.
Yeah.
But I ended up joining their first ever London cohort back in June 2019. And yeah, it was fun. It was exciting. They were not investing in solo founders at the time, but I convinced them to let me pitch to their investment committee regardless. I kind of didn't like the idea of inorganically forming a team, as in the 10-week or whatever it was, 12-week process. Within the first couple of weeks, if you're going to be successful, at least at the time, you had to team up within a fortnight. And I attempted it, but it just didn't feel right. So I said, okay, let me go this alone. What some others did, which was quite smart, is they came onto the program with their co-founders. And others still came onto the program solo and just brought in their external founders or co-founders rather for investment committee. But I went in kind of playing the rules, if that makes sense, as an individual, hoping to find other cool people, which I did. Awesome people. And they were exceptionally good at finding talent and putting them in the room together. But the idea of teaming up for what might be a 5, 10, 15-year journey with people that I just met just didn't sit right. So I did convince them to let me pitch solo, but it was out of thesis for them. So they were never going to invest. But it just got me hungry again to build. And it took me outside of the relationship with those two other individuals and just opened my eyes to the world of other potential co-founders. Then ended up being hired by someone else who was a big tech exec, had then led another big tech company, well, not massive, but like a mid-sized tech company, a few hundred million, let's say, in turnover or market cap, and then was looking to start something from scratch for the first time, and was prepared to put his own money into it. So I ended up joining him as, I guess, the first employee / co-founder, and then hiring a team, probably a bit too aggressively, frankly, hiring too many people too early. And yeah, cut my teeth again, building from scratch with them. And what I realized
on that company then, what was the product?
Yeah, I won't go into it because I've left. If that's cool, but if you
okay,
dig
yeah,
around
that's fine. Yeah, sure.
Yeah. But I mean, they're still going, and
good.
Yeah,
excellent.
Yeah, they've raised a few million quid, I think, but they haven't. This is what frustrates me, and part of the reason that I don't really want to name them is that I think that there can be a disconnect between raising loads of money and that being the benchmark or measure of success, and actually being commercially viable without the need for continued investment, or at least having
this is a common conversation that occurs, I think, in this space. Valuations, investment rounds, all of these various benchmarks that seem to be the holy grail of some sort of success. And I mean, on the other side, there's cash flow. There's there's EBITDA. There's the stuff that really matters on the other end. And unfortunately, depending on what day of the week and who it is you speak to, one is for some reason favored more than the other.
If you are enjoying this episode and want to support the show, please subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
Go figure.
Yeah, look, I mean, look, that venture capital in itself is a really weird and niche asset class, and the vast majority of companies will never be viable as a VC backable company. It's just reality. You are, in my view, unless someone reimagines venture capital, at least how it stands today is you need to have a moonshot potential in order for investors, institutional investors, to back you. Different for angels, right? Not always the case for angels. But institutional money has been pooled from external investors who are investing in an inherently risky asset class and want outsized returns. And they measure that on a portfolio basis. Just because your company did, return 3x. I was having a discussion on LinkedIn about this just now. One chap was saying, like a 3x return would be great. And I was like, no, it wouldn't. 3x is what, at the portfolio level, they might be looking for collectively. But you've got to bear in mind that 80% plus maybe will completely fail. 18% may do 1 to 5x return, maybe. So that means that the remaining 1 to 2% need to completely outperform. They're looking for 100x returns. And it can be, it's really counterintuitive. And we'll talk more about how I got to Underdog X in a second. But ultimately, when I first started angel investing, of course, I believed that I could pick winners. I believe I can consistently pick winners. And yes, if you can consistently, if every single investment that you make in the startup returns 3x, you're going to be doing all right. You'll be outperforming the majority of the market. But we've seen through decades of fund returns and probably angel portfolio returns, those who've made them public, that's not the case. Even if you do everything right, a bit like we were talking about earlier when it comes to careers, you can do everything right as an employee and you still might not make partner. You still might not get the pay rise. Same with investment. You might back exactly the right founders in the right space, in the right company, and external things may scupper your plans and their plans too. So it's not possible to I've at least never seen anyone who invests at the early stage in venture who has had consistent 3x returns. It just doesn't exist. And if it does, please tell me who they are, because I will give them all of my money. No doubt. Or it's a Ponzi scheme.
Yeah, probably the latter.
So it's just not possible, right? And I forget where I was going with that. Sorry, Greg.
Well, just really quickly, while you're trying to remember where you were with that, a thought occurred to me in relation to this relates very much into some of the conversation we had previously as well around kind of the due diligence process and the data collection element of it. in speaking with my team in regards to what we do for one of the services our startup provides for VCs and angel groups and stuff like that. One of the reasons why we were so bullish on it was because we were speaking to founders and investors in my network and our network about it. And there's just this common sense, this feeling of just like you said, no other asset class is like this. You wouldn't invest in any other asset class with the absence of data that you have in venture. Like it is the most data absent investment class that there is. And so when we stumbled across this idea of really looking at, finding ways of, not in a way that's dehumanizing, but trying to find data points on the human aspect of it. How could you do that? Okay, skill, right? Skill and competency can be measured. We can measure that. We have benchmarking for it. It's not rocket science. It's like, okay, that's at least one area that we could do. Like, why wouldn't we want to have that as an additional tool in our arsenal to help us at least assess to some level the viability of an investment? Like you said, you wouldn't do it with any other. It's crazy how scarce there is, data. It seems to be mostly, yep, okay. There's a lot of asks, especially from the VC side. A lot of asks if we want to see this, we want to see that. But we all know, especially early stage, how much bullshit and guesswork is going into that. We all know that. It is really down to gut feeling a lot of the time, and a lot of people having a good gut feeling one after the other, from an associate, right up to partner. Like, and it has to be, that, and that's why people talk about the fact that it's not what you know, it's who you know. Having warm introductions, and maybe having coming from the right university. Like, these aren't data points. What are we doing? You're putting millions into these funds, and it's just crazy to me. So I think we're going to see a serious change on that. I really do believe that in the next few years, where we're going to see this asset class just get a bit more sophisticated, because it is, bizarrely, even though predominantly what surrounds it is tech entrepreneurship, it is pretty much in the dark ages. It's, compared to, like you said, the rest of the investment landscape.
It's somewhat ironic, isn't it, that
Yeah.
these tech investors, well, and it's not to say that they are not trying. So one of the people that I met on the Antler cohort that I was a part of, he actually ended up at one of the big funds, one of the preeminent European funds, trying to develop technology that enabled them to track not just their portfolio, but their anti-portfolio. And as many data points, sucking in as many data points as possible about the founders, the business, whatever they could get, to see if there were any, maybe not causations, but correlations amongst the winners, both in those that they'd invested in and in those that they passed on. Obviously, probably fewer data points to measure or for them to have access to on the anti-portfolio. But equally as well, those founders or startups that they had invested in that had underperformed, were there red flags that they might have picked up on? Look, I find it fascinating. We've talked at length actually about this offline and what you are building. It is also, in my view, I don't know if they've been open about this, but it's certainly, in my view, what Antler is doing, because they are, they're working with for a start, thousands of applicants. So they've got a massive portfolio, if you want to call it that, and hundreds of individuals multiple times a year in multiple cities across the world, and then figuring out who amongst that pool of hundreds of people they will actually back. And now they've got, whatever it is, 7-8 years worth of data points on how those have performed post-investment. Plus, they've now got follow-on funding, so they can continue getting access to data points throughout the journey of these startups. Now, I don't know if it's public. I've got insight into how their portfolios are performing, because I know LPs in various funds. So I'm not saying they've nailed it, but at least they are tracking it, and it should enable them to get better over time. Yeah. So that's important. I think the danger is that we mistake, or we are at risk of mistaking correlation for causation.
Yes.
You mentioned going to a good uni. Yeah, I did go to a good uni, but does that mean that I am going to outperform? It might do, because of my network or because I was good in the first place, which meant that I was able to go to that good uni. I don't know. But is that a cause or just a correlation? Is it luck? Does the fact that is everyone who went to that particular uni going to outperform? Probably not, right?
Right.
So I think that's my only kind of tempering of my excitement around track.
And I agree, because there's a lot of conversation about this. Just for example, the fact that there's a lot of conversation around how the majority of founders are male, right? As an example, right? Especially those that get funding and so on. You have to look further into the analytics and the data there. Is that correlation doesn't equal causation there. The fact is there are just more male founders. And there's a lot more that do that. So if you've got a larger sample size, you're going to get larger funding. Then I'm sure there is. There absolutely is, when you delve into it, some forms of bias across various things. But you can't make that leap to just say, well, that must mean that being a man means you're more likely to succeed. That it's far more complicated than that. As just one example, and like you said, there's the university one. There's maybe the wealth of your family, your race, your religion, where you grew up. There's a whole ton of things, and that concerns me. That really does concern me, because if I think there'd be a lot of false assumptions made there. I honestly think it's a lot simpler. I actually think it's a lot simpler than people give it credit for. I think because of now, what we do is we run the risk of, with this, especially in the age of AI, where we're going to be maybe running into a situation where we're creating too many data points instead of focusing on the ones that matter. We could just be tracking everything, right? How often they pay their loans on time, and this, that. It's none of this matters. You're going to be we're pattern seeking animals. We're going to be finding patterns everywhere. I think ultimately what matters, well, I think there's two main things that matter, maybe three, but two main things that matter. What are the chances that this band's going to break up, right? So in other words, how strong is that relationship, right? That's really important, because if that's the vulnerability, right? The people element of that, the relationships, how well they communicate, etc., etc. That's really important. And then the second part is how good are they at making money? I really think that's fundamentally it. How good are they at selling, or finding the people that can be really good at selling, or training the people that are really good at selling? That's all it comes down to. But the thing is that's so interesting is it kind of, because the way that this whole venture ecosystem has been approached, like we said about pricing rounds and valuations, and you're only as good as your last raise. I think the eye's been taken off that ball pretty significantly, to be like, oh, wait a minute, the number one skill and attribute we should be looking for is how good are they at selling, and how good are they at making revenue, because that metric's so far removed from the everything else that they're tracking, right? But that's it. I honestly think it's that simple. If you can just really focus on those two things, maybe some other action, I think you're golden. I think, and you don't have to track a million bloody data points then as a result. But that's my thesis anyway.
I would broadly agree with that in principle. And there are nuances that I've developed over time, and maybe we'll talk about them in part two. But certainly from my perspective, I agree. You are at risk of getting lost in the enormous noise, especially in the current era, right, where we can pull in so many data points. There's just too much noise. But even if you are able to cut through that noise and to identify what you think are the cogent factors or data points, we're almost applying our own bias to that as well, to a certain degree.
Yeah.
And as an example, we talked about male and female founders. If, as an example, I don't have data on this, but if we are to say that the majority of unicorns in the world have been founded by males, does that mean that male founders are more likely to build unicorns? Or does that mean that VCs have looked at that data point and said, oh, males are going to do better, and they've invested in those males and given them the capital and the runway to be able to outperform? So it almost becomes a self-fulfilling prophecy. Or we are at risk.
There's a lot of that. Yeah.
So, and I don't have the answer to it, and I don't even know what the data is. So, yeah, I'm not sure. For that, I don't have a solution. Certainly for later stage. For early stage, I do, and that's what we're building at Underdog X. But I think, there's a lot of noise. Even if you can cut through it, we must be aware of our own biases and how the actions that we take might impact the outcomes. For example, giving a disproportionate amount of funding to founders from a certain demographic, whatever that might be. And I think more than that, you talk about revenue generation and EBITDA as a proxy for cash flow, which I agree with. Those are certainly markers. And in traditional business, that is what we care about, right? And this is something that I had to kind of unwrite in my own head. Because when I was working for the big companies, yes, you lived and died essentially by your quarterly results, your quarterly reporting. If profits went down, your stock price was going to tank, and that was going to have an impact. If revenues went up, maybe that was a good thing, right? Et cetera, et cetera. Because ultimately, long-term, like forever investors, they care about your ability to generate cash to return to them based on their investment in you. That is what they care about. In venture, it's a bit different. In venture, we're not really looking for income. In fact, we're fundamentally not looking for income. We're not looking for a dividend play to park our money there and take out 5-10% a year. No, it's not of interest. We are looking for outsized capital gains. Very different. And there you can, or historically, you were able to play the system a bit and to say to investors, give me £1 million today, and in 5 years' time, I will do my best to make sure it's worth 10 million. And that a liquidity event happens where you are able to take your cash off the table. So as an example, one of my best angel investments returned 40 times my cash. So for every pound I put in, I got £40 back after 3.5 years. That is incredible, right? That is great. But that was only able to happen because the founders of that company did two things. One, they allowed me to invest exceptionally preferential valuations because we were providing support to them in the early stages. So we got a great deal going in. But almost that didn't matter because what they were able to do is keep raising and raising and raising so that their valuation increased. And then an incoming investor was like, look, let's clean up the cap table. Let's take some of these early investors just off the table if they want, right? We had to say, yes, we wanted it. And we will offer them at a slight discount to the current valuation, their money back, plus any returns. And that led to a 40x return for me, which was great. But that was only able to happen because a liquidity event occurred. If I was still holding and waiting for dividends to be paid from profits, I would have made zero. Does that make sense?
Yeah. Of course, it's a different game, and I've been my very first foray into managing a sales team in a startup, which was a VC backed startup, was that, and it was a culture shock because of to suddenly be responsible for sales figures and the sales team where the goal wasn't revenue was really confusing to me, and it took a long time. This is going back quite a while now, but really then it was we were concentrating on users, on activations, on retention, on churn, and suddenly the goals are very different. But I think the point still remains though that you still need to have that skill in order to do that, right? So it's either way you need it. And the thing that I think is quite often forgotten about is that there's a skill to fundraising. And so just because you've raised once doesn't mean you're going to be able to do it again. And that's another, and that is presentation skills, communication skills, sales skills, whatever you want to call it. But I think that's absolutely it. But yeah, I mean, it is, they're held to a different standard for sure. But you're right, we are at the end of part one though. So thanks for listening and watching. For those that are listening and watching, we are going to take a quick break here. But for part two, you're going to have to come back in a couple of days' time to catch the rest of my chat with Mike, where we're going to go into a bit more of the weeds as to what you're doing now, hopefully. I think we're about ready to get there now, aren't we? Yeah, cool. So yeah, thanks very much, Mike. Thanks everyone for listening and watching. And make sure you come back in a couple of days. That's the end of part one.
Thank you for listening and/or watching. Subscribe with notifications turned on to get notified when part 2 comes out. While you wait, Please join in the conversation in the comments below.